Got it. Okay. And put my machine in tablet mode and hope that it doesn't freak out on me. It's not looking good. Okay. And we should be ready to bring up the impairment, the last module that we had left from chapter 3. Okay. And when we look at this module, they're going to talk about impairments separately between whether it is an intangible asset, which we talked about accounting for intangible assets last time, or whether it is a fixed asset, say property, plant, equipment, that sort of thing. I'm just going to go through the impairment discussion because you start having deja vu when you go through the process. The impairment for an intangible asset, because you start having deja vu when they repeat everything they just said about a fixed asset. When we're talking about an intangible asset that is specifically identifiable and has a finite life. Goodwill is an intangible asset that doesn't have a is not specifically identifiable, does not have a finite life. And so you have to account for impairment for that a little bit differently. And we're going to get into that probably next time as we wrap up chapter 4. So I'm just going to talk about impairment for intangible assets, since that comes first. And we'll see what they tell us about intangible asset with an indefinite life. We'll talk about intangible asset with a finite life. And you would treat a fixed asset like property, plant, equipment exactly the same way as you would an intangible with a finite, with a definite life. Okay, so let's just come over and let's take a look. And we see that when we're dealing with, and again, they're talking about intangibles. We say that if it is an intangible with a finite life, and again, this is the same thing we would do for a fixed asset. Put my computer in full screen here. And so when we take a look at that, the first step is to compare the carrying value of the asset with whether it is an intangible with a finite life, like a patent, or a fixed asset. You would go and look at what are going to be the future and its undiscounted cash flows. Very important. You look at the future undiscounted cash flows that will be generated by that asset. And then you will compare that to the carrying amount of the asset. If the undiscounted cash flows are more than the carrying value of the asset, you would stop and there would be no more evaluation for impairment. I don't care if it's $1 a year for 1,000,000 years, you wouldn't discount those cash flows and the carrying amount would say 900,000, you would stop and you wouldn't do any more impairment calculation. Now, if it turns out that the undiscounted cash flows are also turn out to be less than the carrying amount of that asset, now you have impairment, and you will need to go to step 2, which is you'll compare the carrying amount of the asset to the fair value of the asset, and that will be the amount of impairment that you'll take. It turns out that the fair value of the asset is often determined by discounted cash flows. So this this pass key is actually a pretty good flashcard, although I want you to flashcard the 2 steps as well. But we remind you that to determine the amount of impairment, or determine if there is impairment, I should say, use undiscounted cash flows. Okay, to determine the amount of impairment, they say use fair value, and that is often determined by what? By discounted cash flows. Okay, so you may look at a problem in which they'll give you the discounted, the undiscounted cash flows. They'll give you the discounted cash flows, and you'll have to use those numbers to then maybe determine A, is there impairment? If the answer to the first step is yes, then you would continue to step 2 to use the discounted cash flows to calculate the amount of the impairment. Okay. Now, when you look at this, there are some rules that I want you to flashcard, but what I'm going to do, we'll get into this in F4, but when testing an intangible asset with an indefinite life, and pretty much, guys, we're talking about goodwill in many, many instances. Generally, it is not possible to determine the amount of the future cash flows. As a result, intangible asset with an indefinite life is tested for impairment, comparing the fair value of the intangible asset to its carrying amount. And we're going to see that for goodwill, we will have some very specific steps, and we'll get into the accounting for impairment of goodwill in chapter 4. We won't get to that tonight, but we'll definitely get to that next time. Okay, so just hold on that one, and we'll talk more about that later. Now, what I want you to do is come over, and I want you to just look at the numeric example. Okay, they're going to give us that same information they gave us without numbers in the numeric example. So I see no reason to, sit there and read through a bunch of stuff with no numbers, just to then, look again at something with numbers. So the assets carrying amount is 900,000 in this example. Okay, and what happens? Future cash flows are considered to be $1 million. This is what? This is undiscounted cash flows. And since the undiscounted cash flows are more than the carrying value of the asset, there is no impairment, and we stop. That's it. And that's what the flashcard told us. Step 1, you don't have to go any further. Now, if you look at the situation and the assets carrying amount, say, was 1.2 million, of course, these examples are mutually exclusive, the net future undiscounted cash flows, okay, again, I want you to remember that these are undiscounted, are actually less than the carrying value. Now we have what? Now we have impairment, so we have to continue. And now what we'll do, okay, is we will sit here and we say that the asset is held for use in assumption 1, and the present value of the net cash flows are 700,000. So now they took those same cash flows that they would have done in what we're calling step 1, and they would have discounted those cash flows. Now, maybe the problem will just tell you the fair value. I don't know, but I just want you to understand that if they told you discounted cash flows, that would be the fair value. Okay. Now, what happens in assumption 1? Let's do that one first. Notice what they do. They go ahead and they know that they have impairment. They compare that now discounted cash flow to the carrying amount. They have a $500,000 impairment loss. They will write the asset down, debit impairment loss, credit the asset. That brings it down to the 700,000. Now they will amortize or depreciate that new cost. Again, if it was a fixed asset, we call it depreciation. If it's an intangible, we call it amortization. But we will go ahead and amortize from there. If it had 7 years left and we had written it down to 700,000, assuming no salvage value there, we would depreciate 100,000 per year, and restoration is not permitted. In other words, if it comes back up in value, say back up to $1 million, we can't write it back up. We write it down and it stays down. Okay. Now, in assumption number 2, they're saying, well, the asset's held for disposal, and there will be some costs associated with this disposal, say 100,000. Okay. By the way, what I want you to flashcard there are those rules. Okay, you don't have to flashcard the numbers. But let's go ahead and let's take a look at 700,000, 1.2. So we have impairment of 500,000, just like if it was held for use. But now we have to include those disposal costs because we're not holding that asset for use any longer. We go ahead and we do what? We debit the impairment loss for 600,000, credit the asset. Okay, we write it down. We no longer amortize or depreciate that asset. And that makes sense because you're not going to be using it anymore. So there really is no future economic benefit that needs to be systematically taken into income going forward. However, restoration is permitted. I can write it back up to the 1.2, but I would be capped at the 1.2. Okay, so flashcard those rules as to what happens when the asset is held for disposal as opposed to held for use. Okay, a little different rules there. Now, when you come over, and I want you to come back up, and they talk to us about how to report that. And I want you to come back to, now that we understand what that loss would be, how would we report it? And an impairment loss, that 600,000, that 500,000, whatever it is reported as a component of income from continuing operations before income taxes. So it's like a loss, essentially, that's reported as income from continuing operations, unless the impairment loss is related to discontinued operations, in which case what? Well, we saw way back at F1, remember F1, that what part of the loss that's called out in discontinued operations, gain or loss on discontinued operations, would include what? Would include an impairment loss. So that would obviously be associated with a discontinued operation. Now notice, guys, that's if you're shutting down an entire part of your business, entire segment of your business. If it's just a piece of equipment, remember that's not considered discontinued operations. So the loss on equipment that is being held for disposal, that you're planning to dispose of, still would be reported as part of continuing operations. It's only when you're getting rid of the entire segment that it goes down to the discontinued operations. Question? Okay, if there's no question, then let's go ahead and let's take a look at a couple of multiple choice questions. Again, guys, they repeat themselves. Okay, they repeat themselves in an annoying manner here. If it's, you know, a fixed asset, everything is the same, except I think they changed the word amortization to depreciation. I see no reason to repeat that. Okay, so I'm just going to move you on to our first question for tonight on this impairment module here. And so let me go ahead and launch that poll and give you a shot at that one. Okay, I'm going to give you a little more time on this one, although, well, it looks like, actually, it looks like everybody's had a shot at working this, so it's, you know, we can wait anymore. So I'm going to go ahead and end the poll and share the results here. And, you know, good 82% of us got it correct, which I would expect. But let's go ahead and let's just look at it. And they tell us that the fair value of the asset is 495, the undiscounted cash flows are 515. I look at a question like this, I think to myself, I pray that you get 52 questions like this on your exam, because you would simply have to remember that what? If the undiscounted cash flows are more than the fair value, you stop, there is no more calculation, there's no impairment loss. Simple rule to remember. For the folks that missed it, am I missing something that made that more difficult than it needed to be? Okay, guys, make sure you're following along here. Tuning out and just selecting a choice just to, you know, get it out of your face is a waste of your time. Trust me, whatever else you're trying to do while you're not listening to this isn't helping you with what you're working on or what you're dealing with, nor is it getting you towards the goal of passing the exam. Okay, even if you don't plan to take the exam anytime soon, pay attention to this stuff. You're going to set aside 3 hours to be bothered to even press a button with this stuff, then you know, you might as well listen. Okay, Okay, good. Let's go ahead then and let's take a look at this next one. Question like that, guys, should take you like 30 seconds to work. You took about a minute and a half, which is okay. First go around with this stuff, but those are questions that you gain time on the exam. It should take you about 30 seconds to read through something like that and answer it, maybe 40 seconds. Okay, we're about a minute and a half into this, so I'm going to go ahead and end the poll. And looks like everybody's had a chance to answer this, but we take a look, and most of us got it right. One person, for some reason, wanted to choose C. And when you look at this, and again, I'm having trouble kind of explaining why some of the wrong ones are wrong. You know, they tell us that they had written it down, and then they want to know, well, what should happen in the second year when it increases in value? And the answer is what? Since it is an asset that is used in operations, then restoration is not permitted. And so there would be zero effect in that current year, because if it comes back up, you don't write it back up. Question?
Is there any kind of asset where it would be written back up? I mean, other than maybe a trading security or something?
Well, we're not talking about securities here now. We're talking about intangible assets and fixed assets. We're not talking about financial securities.
So that's what I mean. Is there anything that would get written up though in any case? Could it be?
Well, we'll get yes, and we're going to get to that here in chapter 3.
Oh,
yeah. Okay, but when we're here, we're talking about fixed assets like property, plant, equipment, or intangible assets other than one with an indefinite life, which essentially is goodwill, and we'll get into that in chapter 4. Okay, question? Okay, good. Let's go ahead then, and let's finish that chapter. We're done with that. So I can discard that, and I can put up what I do, close everything, of course. So let me find it again. Wrong software. And this one. Okay, here we go. And let's take a look. Okay, financial instruments. Okay, and when we get to financial instruments, we're going to be talking about stocks and bonds. Okay, and we're going to be talking sort of your question, Eric, about how to account for trading securities, available for sale securities, held to maturity securities, which really are bonds, our debt instruments. We'll talk about fair value through net income method, which really is for our stocks. Okay, so that is about 5 points on the exam. Then we're going to talk about the equity method. Equity method is an accounting for stocks that is about 5 points on the exam. And we're going to see that if we get to a point where we own enough of the company where we can determine that we exert significant influence, we're going to have to switch from the fair value through net income method for our stocks investments and move to the equity method. Then we'll talk about consolidations. Okay, and when we talk about consolidations, and I'm going to go ahead and bracket off this entire thing, that has long been a 10-point area on the FAR exam and its predecessors. Okay, now just a side point, by the way, on March 21st, and you know what, guys, I'm going to hold off on that announcement because now it's not making any sense to me. What year am I looking at? 2024. That's probably why that's not making any sense to me, because this is 2023. Hang on, let's set it. Even though this calendar is the cutest thing in the world, it's not the most functional. It's cats and dogs saving from throwing this calendar away. Okay. Yeah, on March 21st, we are scheduled to have a live class, an in-class meeting where I will be on campus. You don't have to come to campus, but before class, and they haven't determined the exact time, I will be giving a presentation to Golden Gate students at large about the new CPA exam, okay, and how that's going to look, and what Golden Gate's plans are for that. But it's worth maybe noting here that consolidations will no longer be part of the FAR exam under the new format. It'll be moving to the business accounting and reporting section. And I hear some folks speculate, well, that means no one's going to take the bar exam because everybody hates consolidations. Well, I don't know that that's true, but it has long been and probably will continue to be a heavy point area even on the new exam, about 10 points. And as I've advertised, we will be talking about goodwill, and that'll be about 2 points. So I'll be giving you some more information. I don't know what the location is going to be for that. They have a bad habit of not answering my questions. So I said, well, what location? And it went into some ether. So I'm not sure the location I know the location for our class that day. If you want to come and, see the class live on campus, you don't have to, but if you decide you want to, there'll be the location is already listed for the class that'll start at 5 o'clock, but where the location will be for that presentation about the new CPA exam before that, I don't know yet. Okay, so stay tuned for that. So that gives you a sense of the point value here for these topics, but let's just go ahead and let's start to talk about the nature of what we're considering financial instruments. And look, guys, they start to get into, things that are considered financial instruments like cash and whatnot. And I just want to keep this, relatively simple. We're talking about stocks. We're talking.
Professor, I have a question for that CPA presentation. Would that be in Zoom too?
I imagine it would be, yes. I don't know for sure because, it has to be a Zoom, although I could always hit the internet, hit the Wi-Fi, I should say, Golden Gate, and use my Zoom to do it. So I would say, yeah, I'll probably do that Zoom unless something weird happens. Yeah.
Okay. And that starts at what time?
I don't know. I'm thinking, 3 o'clock or something. I mean, I apologize that I don't have better information for you, but I asked the questions. Somebody else has to answer those, and they don't answer me. I don't know. It's the weirdest thing I've ever seen. I ask a question and they go radio silent. They come to me and say, we want you to do this. I say, okay, great. I'm happy to do it. What time? What location? Radio silence. Okay. But I'll be having to push them for that a little bit more here by next week, we should know.
Okay. Thank you.
Okay. Okay. All right. Good. Now we look and we're also going to talk about bonds here. Okay. Now, we talk about the fair value option and what happens. They tell us here that there are some securities, bonds, that you can treat as Eric was indicating, you can treat as a trading security and available for sale or a held to maturity. Okay, and it really depends on the intent of management to determine whether the bonds go into that category. For stocks, we have to use the fair value through net income method unless we own enough of the investment to now say we exert significant influence. And so we are going to use the equity method. We're going to talk about that method here in a little while. Okay, but they tell us if you are having a bond that you have determined is an available for sale or a held to maturity, or if you have enough stock to constitute using the equity method, if you want to, you can make a one-time selection to treat that as though it was a fair value through net income investment. In other words, you could be treating a bond as though you were going to treat it as a trading security, or if you were holding enough stock to use the equity method, you could elect to use the fair value through net income method. Okay, so what they tell us is under the fair value option, okay, if a company chooses that, okay, for things that are typically not carried at fair value, again, for bonds available for sale and held to maturity, for stocks, those that you would have normally used the equity method, you can use the fair value method, and under that situation, unrealized holding gains and losses will be reported on the income statement. Okay. Now, flashcard, that once you elect that fair value option, it is irrevocable as to that specific instrument that you choose to use the fair value method. Okay, so it's a one-time election. You can't reverse it. It would apply to what? To bonds that you're carrying in, say, available for sale or held to maturity, to stock where you have constituted, you would be warranted to use the equity method, but you choose to use the fair value through net income method. Okay. Now, when we look at this, they tell us that we can do this. Okay. You can use to measure fair value debt instrument that would otherwise be classified as available for sale with unrealized holding gains and losses in earnings rather than OCI. Or if you have if you have something that is going to be held under the equity method, you could use the fair value method, which is essentially what I had just said verbally. Now I read it to you, flashcard that. And then they tell us that financial instruments not eligible for this option are, and basically, guys, if you have to consolidate, and we consolidate, and we'll talk about that maybe a little bit tonight, definitely quite a bit next time. If you have to consolidate, then you are not allowed to use the fair value method. You have to go ahead and consolidate. So flashcard that. Okay. Okay, good. Now you come over and let's start out talking about our bonds. Okay, we're calling them debt securities, but for the most part, okay, it's just fine to just picture that we're talking about bonds. Okay, we're talking about corporate bonds, whatever. Okay, now we come over and we have one of three categories, either trading, available for sale, or it could be held to maturity. Okay, now what we're talking about here in terms of classification, okay, we're going to get more into some of the discussion of these, is to whether they should be current or non-current assets. Okay, so you've invested in the bonds of some other company, and now you're trying to decide if you should carry that as a current or a non-current asset. Okay, now let's see what they tell us here. Trading securities are debt securities that are bought and held principally for the purpose of selling in the near term. Trading securities generally affect active and frequent buying, and they are going to be carried as, here it is, talk about bearing the lead here. Debt securities are classified as trading, are generally reported as current assets. Okay, and then they argue with themselves, although they can be reported as non-current if appropriate. Well, look, okay, I guess if the problem tells you they appropriately carried it as a non-current, then be non-current. don't argue with the problem, but usually they want you to decide where it should go, and the rule of thumb is for it to be current. Okay, and there's no triggering criteria really that would have it be non-current. Okay, now you come over, and if it's an available for sale security, they do not meet the definition of the other two classifications. So let's look, and the way I wanted to do this is let's look at held to maturity, since they're telling us available for sale is neither trading nor held to maturity, and investments in debt securities are classified as held to maturity if the corporation has the positive intent and ability to hold that security to maturity. Okay, this gets interesting when we start studying for the auditing exam, because how you audit management's intent, we're going to see that we're going to make them put in writing to us. It's something called a management representation letter. Their intent is to hold that to maturity. Okay, so if that's the case, it is going to be classified. Boy, they put a lot of nonsense in here. Okay, securities classified as held to maturity are reported as either current or non-current, depending on the time to the maturity. Okay. Okay, good. They put a lot of other stuff in there that is sort of bearing the lead here. Now, we said that what available for sale securities are those that do not meet the other two categories. Okay, it's neither trading nor available nor held to maturity. And if that's the case, it could be current or non-current, depending on the intent of the corporation or its time to maturity. Right, because if it's going to mature the next year, then it would obviously, they can't hold it beyond its maturity. So then it would have to be current. Okay. All right. Now you come over, and that's the classification on the balance sheet as to current or non-current. When we look at the valuation, okay, let's take a look at the valuation here. And if it is a trading security, okay, and there are unrealized gains and losses. Unrealized gains and losses on debt classified as trading securities are included in earnings. In other words, they are recognized on the income statement. So if you have a gain, for example, you would debit the security, credit the gain. If you have a loss, okay, which what they're showing us here, debit the loss, reported on the income statement. The gain would be reported on the income statement as well. And you could either credit the valuation account or credit directly to the account to bring it down. You could do that as well. Okay. Unrealized gains and losses on available for sale. Okay. And really the takeaway here is that unrealized holding gains and losses are reported in other comprehensive income. And we even practice a little bit with that in F1, okay, but you start to take a look, and we are going to include the unrealized loss. If it was a gain, it would be a credit to unrealized gain, okay, the debit would be to the security. Here we could credit the security, or you can use the valuation allowance for that. But that is what? That is OCI. Okay. Now, once you actually sell the security, all realized gains and losses ultimately will hit the income statement. Flashcard that. Once you sell the security, everything is going to go to the income statement. Now, I'm going to go ahead right here and show you the example for dealing with an unrealized gain and loss on available for sale security, just to review that process. The book, Becker has an example too, but I feel like their example just goes way overboard and is way too complex for what we need here. So I'm just going to go through this little simpler one that I put together. Okay. And so let's just look at it. Okay. And we have a company purchased a marketable available for sale security for $24. So when they buy the security, they debit the security for $24, they go ahead and obviously they credit the cash when they buy that thing. Okay, now I'm going to go ahead and I'm going to tee up security. And I'm going to tee up accumulated other comprehensive income. Okay, now what happens when they go ahead and they look at the end of the first year and the securities come up to 27? Okay, so they originally debited for 24. The security goes up, and so since it is an available for sale security, by the way, the balance sheet effect would be the same if it was a trading security. You increase the value of the security. So I go ahead and I debit that security for $3. Post that debit. Now it's being carried at 27. Okay. And I credit OCI gain for 3. That is reported not on my income statement, but on my what? Comprehensive income. Comprehensive income. Okay, now ultimately what happens? I would close my comprehensive income to what? To accumulated other comprehensive income, because accumulated other comprehensive income, remember guys, is like the retained earnings of comprehensive income. So just like you close net income and retained earnings, we would close my other comprehensive income, okay, to the accumulated other comprehensive income. Now, in year 2, okay, I would go ahead and I would look at the value of that security again. And now in year 2, I'm saying, well, now it's worth 28. Okay, so it's gone up another $1. And then I say that in year 3, okay, let's just do a little annoying change of color here. In year 3, then it is sold for $30. Okay, so what do I do at the end of year 2? Okay, that's that journal entry there. Debit the security, credit other comprehensive income for 1. Okay, when I debit the security, now the security is up to what? The 28. Okay, and I would close my other comprehensive income gain that I would show as part of my comprehensive income. I ultimately would close that to my accumulated other comprehensive income, because that's the retained earnings of my other comprehensive income. Okay, then finally in year 3, right, I go ahead and I sell the security, okay, right here. And when I sell the security in year 3, of course, I will debit the cash for 30. I'll credit the security for 28 to get rid of it, because that security is gone. Just get rid of that, okay? And then I'm going to look and I'm going to have to debit unrealized gain on available for sale security. And I'm going to have to debit that because I need to take that and ultimately what? Close it out. And I need to close it out to my accumulated other comprehensive income. So I would show a subtract for unrealized gain on my comprehensive statement of comprehensive other comprehensive income. I would close that out to my AOCI. That closes that out. And then I come over and I credit what? I credit realized gain for the full 6, the difference between what I originally purchased that security for, the 24, and what I ultimately sold it for. So if you're seeing a problem where they run you through all kinds of, well, first it was this, then it was that, and then it was that, and ultimately they sell the security and they ask you what gain should be reported on the income statement, it will always be, what did they originally pay? What did they sell it for? That difference is, in this example, gain. It could be a loss. And that's what that thing I had you flashcard on that page was talking about. Question. Okay. Now, if it is an asset that is being carried at amortized cost, okay, you're simply going to carry it at its face plus what? Plus any unamortized premium, or what? Face, and it has to be one or the other, minus any unamortized discount. Okay, and we'll get more into that in F5, but essentially that's all that's happening there. You're just going to carry at what when they say amortized cost, that's what they mean. What is its face plus any unamortized premium or minus any unamortized discount. It can't be both. And we'll get into detail on that in F5. Okay, okay, good. So that means that if there are unrealized gains and losses on held to maturity security, they are not recognized in the financial statement. You can flashcard that. You know, the idea here for a held to maturity security, right, which is what we're talking about here, is if you're going to hold it to maturity, FASB looks and says, well, it's really not fair to be making a company write that up and down and having all these fluctuations on my income, my other comprehensive income, when at the end of the day, it's going to have no ultimate impact on the financial position of the company. So just keep it at that amortized cost. Now, of course, there would be what? The amortization of a premium, the amortization of a discount that would affect our interest income. And we'll get into that in F5 for bond investments that are carried, that are held to maturity. Okay, now we looked at some of those things as to how, yeah, right here, how to treat the securities, whether current or non-current, etc. Okay, but I think I didn't ask you to flashcard in those other places because I think it's fine to flashcard it right here with this table. Okay, when we get to cash flows, okay, let's take a look at the cash flows, and we've already sort of talked about these other columns here, but let's talk about the cash flows. Okay, so under US GAAP, which is all that's tested on the CPA exam, trading and debt securities are classified in operating cash flows or investing cash flows based on the nature and purpose for which the security was acquired. If trading debt securities are classified as non-current on the balance sheet, then the trading security will be reported as investing cash flows. If trading securities are classified as current on the balance sheet, then the trading debt security will be reported as operating cash flows. And since most of the time a trading is going to probably be current, okay, then it's probably going to be operating. You can see that for the other categories, what we put any transactions purchasing or selling those off as investing activity. Okay, now this reclassification gets a little interesting, and I look at this and I'm thinking to myself, this stuff looks a little wonky even for the CPA exam, but since it's here, let's just go ahead and I'm going to ask you to flashcard the table down here in a second. Okay, but I don't know, this seems even a little too much even for the CPA exam, but let's see. If you are moving a security from trading to any other category, okay, from trading to available for sale, from trading to held to maturity, then you will not reverse any unrealized holding gains and losses that have already been taken into net income. If you go to held to maturity to available for sale, okay, then unrealized holding gains and losses, the date of transfer had already been reported under comprehensive income. And so the unrealized holding gain and loss, the date shall be reported in other comprehensive income at that point in time. You were held to maturity, now you went to available for sale. So take any difference between the market value at that point in time and the amortized cost that it's being carried at and immediately transfer that all to other comprehensive income. Now, where it gets interesting is if it is in available for sale and you transfer it to held to maturity. Now, unrealized holding gains and losses that were already reported in other comprehensive income, the unrealized gain or loss shall be amortized over the remaining life of the security as an adjustment of yield in a manner consistent with the amortization of a premium or discount. Okay, now that's something that doesn't exactly jump to mind as to what they're talking about. So let's just go ahead. I'm going to have you write in a little example down here. Okay, so say company purchases a 10-year bond, and they purchase the 10-year bond at face of $100. Okay, now I'm going to tee up the bond over here. So they bought it at face at 100. Okay, now let's say over the 5 years, the first 5 years that they hold this security, they're treating it as an available for sale security. And let's say we have unrealized gains of 10. So at that point, accumulated other comprehensive income would have 10 in it, and the bond would have been written up 10 because it's held for maturity. You close out your other comprehensive income to accumulate other comprehensive income, and over 5 years, it had gone up $10. Then what? Then in year 5, I guess I should put what happened first 5 years security increases in value to 110. Okay, so it increased in value to 110. We increased the security. We increased our other comprehensive income, which got closed out to accumulate other comprehensive income, which is like the retained earnings of my comprehensive income, right? Okay, then what happens? Then, just continuing on, in year 5, they reclass security to held to maturity, which is what got us to this example. Well, what they would do, and they would do this in years now 6, I said in year 5, year 6, 7, 8, 9, 10. So I guess it'd be year 6. Okay, so for the first 5 years, it increased 10. And then in year 6 through 10, the last 5 years, okay, then what they would do, well, in year 6 it happens, and then the journal entry that they would make in years 6 through 10, okay, they would have to, and I'm just going to write the journal entry over here, they're going to debit OCI $2. They would take that $10 and divide it by the 5 years that were left on that, and they would go ahead and debit OCI for $2 in year 6, year 7, year 8, year 9, year 10, and they would credit the security, is the bond here, for $2. Okay, and they would do that 5 times, and when they do, of course, they have to close OCI to accumulate other comprehensive income. But by the end of year 10, when the security is maturing, it's going to mature what they purchased it at face. It's going to mature at face of 100. So they would debit cash, credit the bond, and the entire amount would have been taken out of accumulated other comprehensive income over those last 5 years. Okay. Question.
The last part, you said when we get cash, we get 100.
Yes.
and the bond is already valued at 100 in the book.
Mhm. Yeah, because we would have, I guess I have to write it 5 times. 2, 3, 4, 5, right? We would have credited it 5 times there, right? So, and I would have debited this 5 times. So the accumulated other comprehensive income for this security is zeroed out. The amount that we had written it up is zeroed out. Now, well, now we have 100. Bonds always mature at face. So I'm going to get a debit to cash and a credit to bond, right?
Yeah.
Okay. Okay, good. Okay, now flashcard this, you know, again, I think this gets a little wonky though, but you can go ahead and you can turn this into a flashcard. Maybe if it's not already a flashcard like this in your pre-made flashcards, maybe copy this and stick it on a flashcard and you'll be in good shape. Okay. Okay, good. Now you come over and obviously, don't forget, guys, if it's a debt instrument, okay, we still would have what we still would have, and I don't know why they're limiting it to trading and available for sale here. Because if it was a held to maturity, there would be interest income. I guess they're making sure we understand that not only would you be doing the things that affect other comprehensive income and affect net income for trading, other comprehensive income for available for sale, not only would you have the effects as the value changes, but you'd still be taking the interest on the income statement. And of course, the interest for a held to maturity bond would also hit the income statement. So I don't know why they probably should have said trade. I'm gonna write it in trading too. I guess they're just trying to remind you here that you'd still have the interest on those, and there would be that effect. Okay. Okay, good. I mean, I think the way I handled that when I marked my book up is I didn't even call out the classification. I wanted to highlight interest income from investment in debt securities is reported on the income statement. I don't care the category. Okay. Okay, good. Now you come over and if we have impairment, okay, and let's see how we deal with impairment. And we're sitting here and we're saying, well, you write the security up, you write it down, you know, for trading, for available for sale on the balance sheet. But if the decline in a held to maturity security is considered to be permanent, then we are going to go ahead and have to write that down for that impairment. You don't write it up, but you do write it down, okay? So we will go ahead and we will have to write that loss down, and it should be reported as the difference between the amortized cost and the present value of the principal and interest expected to be collected, okay? And so the credit loss here, they tell us what I just said is the difference between the amortized cost and the present value of the principal and interest. So you can flashcard that, but let's just take a look. And we have this $500,000 4-year bond purchased at the interest rate, and they classify the investment as held to maturity. Okay, at the end of the 3-year TGPO received, isn't that cute? Tim Garrity and Peter Olinto, aren't they cute? Received the full interest payment of $21,250, but determined that it could only collect $11,500 each year in interest for the remaining 3 years, and then they would get the face of $500,000 at maturity. Okay, so what do? They go ahead and they give us the present value factor of $1 for 3 periods. and they give us the present value of the annuity for the remaining 3 periods. We apply the present value of the dollar, okay, to the 500,000, and we apply the present value of the annuity factor to the remaining interest payments that are coming in. And when we discount that, it says, hey, this security has a present value of 473. It's being carried at what? At 500,000. So we have a impairment of 26,000, excuse me, 927. So, and why don't you go ahead and flashcard the journal entry here to recognize the credit loss impairment on a held to maturity bond. Okay. Now, if it is an available for sale security, well, now it's going to be a little bit different, because now they're sitting there saying, well, if it's available for sale, you could sell it. You could sell it if it starts to drop in value. And if that's the case, do you really have to take a credit loss on the income statement for that? And it really depends on how much that drop in value is determined to be. Okay. So what happens? You take a look, and they tell us that impairment on available security is counted differently than held to maturity, because the investor has the option to sell an available for sale security if the loss on the date will be less than the expected credit loss. As a result, okay, the credit loss reported on the net income on the available for sale is limited to the amount by which the fair value is below amortized cost. Any additional loss can go to other comprehensive income. Let's look at the example here, guys, and I think you'll see these different scenarios here. Same thing that we talked about before, where we're going to look at the present value of that security, its fair value, excuse me, versus its amortized cost, and see what we should do. Now, in the first case, it's more than the 500,000. In the second scenario, it's less. And in the third scenario, it's even less. So you come over and you take a look, and let's take a look at that first scenario first. And what happens? Well, they tell us that the amortized cost is 500,000. The fair value, though, is 510. Now, what I find a little annoying here in this, and I don't know if FASB was bored when they came up with this whole thing, or what was going on exactly, because I'm looking at that and I was thinking, well, why would there be an expected credit loss when the security has a fair value that's more than its amortized cost? I don't get it. I mean, why would somebody be willing to pay more than the amortized cost of a security that is not going to come in and give you present value at a higher amount? So anyway, but if you saw a problem that was the case, well, since they could sell it, it's available for sale, and they could sell it for 510 presumably, then they really have an unrealized gain. Okay. Now, if you're looking and the security in scenario 2 was sitting there at 480, which to me, this is probably a little more realistic as to where you would start going with this, then you would be looking and saying, well, they could sell it. And if they sell it, then they would go ahead and they would still they would take a credit loss, but they would take that credit loss of 20,000 and they would be capped there, because they're saying, well, if they wanted to, they could sell it at a $20,000 loss, and that would be a loss for OCI, but you have to at least take what the amount of the credit loss would have been if you had, if it had a fair value that was below the 480, like we're seeing with the next one. And when you look at the next one, okay, we have what? We have a total loss of 50,000. Okay, and they tell us what? They tell us, well, look, if you've got a total loss of 50,000, now you're going to have to break that up. And so you're going to have to do what? Take the 26 927, okay, of credit loss. You have to show that, which was calculated the same way we saw earlier. Now there's a remaining what? 23,073 that they will allow you to put into the unrealized loss, because you do need to bring it down to the 450, but you have to first take an amount against the credit loss on that. Okay. Okay, so like I said, I don't know, was FASB bored the day they came up with all this? Because I'm just looking at this and I'm just like, okay, I guess they just want to make sure that you put certain amount of losses on the income statement for this. Okay. Okay, good. And then again, and they show us the journal entries here. We don't need to worry about that. Trading securities always take the amount to net income. Okay, the difference between the cost and the amount that you sell it for will always go into net income. And when you ultimately sell an available for sale security, that also, the difference between what you pay for it and what you sell it for goes into net income ultimately. Okay. Okay, good. So let's look at that available for sale. We already saw that, okay, in the little example that I gave you. The unrealized gain or loss when the available for sale debt security is sold is the difference between the selling price and the original cost. You can flashcard that. Okay, and I can tell you to see example, because we already did that example where I had the security that I bought for 24 and then ultimately sold it for 30. Eventually we had that 6 that went into the realized gain. So I gave you that example already. Okay. All right, good. Question. Okay, I'm sensing, guys, a need for a break. So I'm going to go ahead and do that right now. I know we're a little early, but we've talked about debt securities. Let's give our brains a rest here, and then we'll come and start talking about the accounting for investment in equity securities, essentially stock. If we need another break later, we can take that as well. Okay, so I'm showing what, about 6:08 or so. Let's come back at 6:20. Okay. Okay, guys, so I've gone ahead and resumed the recording, and we're going to go ahead now and start talking about how to account for investments in stocks, essentially, and calling it equity securities. We're pretty much talking about stocks. Okay. Now, when we come over, okay, we can see that we are to use something called the fair value through net income method. Okay. Now, this is the case for stocks unless we have gone past a certain ownership significant influence threshold that we'll talk about later when we get into the equity method. Then we would use the equity method unless, as we saw, the company had decided to use the fair value through net income. So for most stock investments, we're going to use this fair value through net income. Unless we own a certain large amount of stock, then we would move to the equity method. Okay, so you come over and you can go ahead and flashcard, but it typically does not apply to investments that we're supposed to be using the equity method for, that we'll study here in a little while. But again, you do have that fair value option that you can make for certain debt securities available for sale and the held to maturity, and stocks that you are, using, you would think you would use the equity method for. Okay, now you come over and let's take a look at the valuation. Okay, and our equity securities under the fair value through net income, any unrealized holding gains and losses are going to run through the income statement. They're going to be shown in net income. Okay, there is no more treatment of comprehensive income now. That relates to bonds. Okay, now you come down and they say, well, what else hits the income statement? We also will have dividend income will hit the income statement as well. Okay, so we have really two earning flows hitting the income statement, okay, which is what? Which is our dividend income and then the valuation. And it could be a loss, could be income, depending on which way that is gone for our debts, our equity securities. Okay, so if that's the case, as long as it is a non-liquidating dividend, you obviously would debit the cash that you got and credit the income. Okay, now what happens? You could have a liquidating investment. Okay, and that happens when we have received a distribution that is in excess of our share of the retained earnings. If that's the case, then you will go ahead and reduce the investment account by the amount of that liquidating dividend. Now, let's just go ahead and take a look at this fact pattern. You'll see that this is pretty easy, and that all we're going to need to do is look to see, well, we own 10%, so we're using the fair value through net income method. The company, the investee, paid a dividend of 10 million and had retained earnings of 8 million. And when the dividend was declared, ABC received 10% of the million, or of the 10 million, excuse me, or $1 million, and recorded the dividend income of 800,000, which was the 10% dividend income of 800,000, which was 10% of the 8 million that was in retained earnings. The remaining, what, 200,000, then in that situation would be a reduction of the investment because they pay out more than the amount in the retained earnings. I don't know. I guess maybe there's questions like that on the exam. I find that sometimes the CPA exam gets into every possible weird thing, okay, and wants you to memorize that to be able to, answer a question on it. Meanwhile, the chances that a company would pay a dividend in excess of the retained earnings, I don't know how common that is. I don't think it's very common, but anyway, there it is. Okay, you got a flashcard for that. Okay, now you come over and you take a look at required disclosures. Okay, let's just jump down to that. And when you have required disclosure now for these, okay, the things that you're going to have to disclose for your securities that you're classified as, you have some that are available for sale and held to maturity. You must disclose their aggregate fair value, gross unrealized gains and losses, amortized costs by majority security type, and information about the contractual maturities of the debt security. So flashcard that. Okay, and then for fair value, just come down, and all public and private entities must disclose on the balance sheet or the notes, the financial statements, all financial assets and liabilities grouped by measurement category, fair value through net income, other comprehensive income, or amortized costs, and if the what is the form of the financial asset. Okay, just flashcard disclosure things, guys. I mean, I don't have much more to say than they're telling you have to disclose that. Make a flashcard of things that you have to disclose. Okay. Okay, good. So with all of that, they give us this comprehensive example, guys, which I think is too much for us. I think that we are able to answer all the questions on how you treat, and the main trick is how you treat available for sale securities. We're going to be able to answer that just from that one example. So let's just go ahead and let's take a look at a couple questions here, see what we have. Who picked B? Who picked B? Who picked A?
Was it the question D as in David?
No, B. I asked for B as in boy, and I asked for A
Okay.
as in Adam. Nobody will admit to those because they're not listening, and then they're just picking things because just to pick them. If you're doing that, just leave class. Don't mess up my percentage of who's understanding the material. Okay, there's no point in that. At no point in any of this discussion did we even utter the phrase lower of cost or market. So if you're picking lower of cost or market, I'm offended because there's no way that you could have come up with that as a choice. Okay, the only possible choices here would be C or D, because we've been saying that what if it's a trading security, it has to be carried at fair value. Okay, and that's what we've been saying the whole time. And then what? And then when you look at C, which is not correct and nobody picked, withholding gains and losses included in earnings to the extent of previously recognized holding losses. We never said anything like that. So I see why nobody picked C. I'm fine with that. Nobody picked it. And then when we looked, and most of us, I appreciate that most of us got it right, which is choice D, which when you look at choice D now, they're telling us that, I got to get out of this. They're telling us that what? It's fair value with holding gains and losses included in earnings because it's a trading security. Okay. So guys, if you're playing some game with me that you're just going to show up here just so I see your name on the screen and then you're just going to click on an answer when I put it up, just go ahead and leave. Okay. There's no reason for you to stay here. Okay, we've got way too many serious students in this class to hold us up with stuff like that. Okay, let's go ahead then and let's take a look at question 2. We're at 2 minutes now. I'll give you a little more time on this one. Okay, we're coming up on 3 minutes, guys. Looks like most of us have had a chance to try this. I'm going to scare some people away. Okay. But I'm happy with the result here. Most of us got the correct answer. A couple of us got C here, which is not right, but I can understand that mistake. So good. That's a much better, attempt than what I've seen from last time. So good. Okay, but let's go ahead and let's just look at this one and see how we can determine that B is the right answer. So you look at this and they tell us that they had their available for sale securities and they had cost of 170,000. Okay, now what I'm going to do is, I'm not always a fan of T accounts, but since they're asking me the ending balance, I could do that. And they're telling me that it's a debt security, it's available for sale security. And they bought it for 170,000. That was the cost. Okay. And at December 31st, year one, they reported an unrealized loss of 1,500. So they would have credited available for sale security 1,500. And in my accumulated other comprehensive income, then I would have had that debit that would have sat there after I closed my OCI to accumulate other comprehensive income of 1,500. Okay. Now, at that point, then the balance in the security account, and this is at 12/31, year one. Okay, the balance at that point is going to be 168,500. Okay, and then they tell me that what? They tell me that by the end of year two, the security is at 148. Well, if I want the security to be at 148 and it is sitting there at 168,500, that means, and it's asking in my year two statement of comprehensive income, what unrealized loss should I take? I should take enough to bring the security down to what it's carrying at the end of year two, which is what? Which is going to take an additional 20,500 of loss on that. And which is the answer to this question. That brings it down to what? To the 148. And the question didn't ask me this, but 20,500 would go here. So I see why some folks would have picked 22,000, but that question asked what happened just in year two. 1,500 of that was taken in year one, an additional 20,500 was taken in year two to bring the security down to the 148. And so that's why B was the correct answer and not C. Question. Okay. Okay, good. Let's take a look at question 3. Okay, it looks like most of us have had a chance to look at this one, and we're coming up on 2 minutes now. So I'm going to go ahead and I'm going to share the results, and almost everybody got this right. Okay, so you take a look, and they say that an investor uses fair value through net income. Dividends received this year exceeded the investor's share of the investee's undistributed earnings since the date of the investment. What should be the amount of dividend? And it's what that's reported on the income statement, the part that was not in excess of the investor's share of the undistributed earnings since the date of investment. And the little example we looked at, that'd be the 800,000. The remaining, in the example we saw, the 200,000, whatever that number is going to reduce the investment account. Okay, good. Let's take a look at the equity method. Okay, and let's see what they tell us. And the equity method is used when we can exercise significant influence over the investee. Okay, now we're going to see here that the rule of thumb is that if we own between 20 and 50% of voting stock, then we are presumed to be able to exercise significant influence. Now you say, well, why do we stop at 50%? Because once we cross that 50% threshold, 50%, 0.11111, whatever, then 0.00001, then we would have to consolidate. Okay. Now you can go ahead and flashcard that, that we would use the equity method when we go past that 50%, past that 20%, excuse me. What would we use if we were less than 20 to count for an equity investment?
Fair market value.
Good. Fair value through net income. Good. And again, we could choose to use fair value through net income instead of the equity method, but once we do that, we're stuck with that. Okay. Now they look at they warn us down here that the CPA exam frequently presents questions in which the ownership is below 20%, but we still have the ability to exercise significant influence. If that's the case, the equity method should be used. And a lot of times what you'll see in a question, flashcard that because that's important. A lot of times what you'll see in a question is they'll say, well, they own 20%, but somebody else owns 40%. Well, how can I exercise significant influence if somebody else holds 40%? Okay, so they tell us in the following situations, the equity method is not appropriate, even if the investor owns 20 to 50%. Okay, so let's flashcard some of those because that's sort of the trick. They're going to try to trick you into using the equity method all the time when you're at that, beyond that, 20% or more threshold. But then they'll say something like you're in bankruptcy or the investment of subsidiary is temporary. There's a lawsuit, standstill agreement. Again, another small group has a majority. For example, somebody else holds 30, 40%, whatever. Coming over and continuing on the next page, the investor cannot obtain the financial information to use the equity method. The investor cannot obtain representation on the board of directors to exercise significant influence. So flashcard those instances because they do like to put those in questions. Now, let me ask you this. What if I own 15% of the stock, but everybody else owns 1% of the stock? All the other shareholders, they all have piddly amounts, 2%, 3%. Should I use the equity method? I'm below the 20%, but there's nobody else that's even close to this 15%. What should I do?
Yes, because you have significant influence.
Good. So it's and, put the word and in there, and vice versa. So even if you are what? Below the 20%, if the problem vice versa, that's the other way around. Even if the question says, well, you're at 15%, but you exert significant influence, use the equity method. Now use the what? use the 15% for any calculations, okay, but you would still use the equity method, and you'll see what I mean by using the percentage for the calculations, okay, here in a couple seconds. Now, you come over and let's just take a look at what happens under the equity method, okay? And so let's just understand it through the journal entries here, and we're going to look at some numbers here in a second. But the main three journal entries, when you acquire the stock, you obviously debit the investment, credit the cash. Okay, now what happens? Then you'll go and you will report on the income statement. Okay, that's on the income statement. Okay, and that gets a little confusing because they call it equity, and to me, equity kind of means something on the balance sheet. On the income statement, you report your share of the subsidiary's income. So you take the percentage you own times their income. That's the amount that gets reported on the income statement. And the debit will go to the investment account. And then if there's a dividend, the dividend is not treated as income. It's treated as a what? A distribution back to the owner, so you reduce the amount of the investment at that point in time when you receive the dividend. Now, let's look again at let's look at a numeric example here, okay? And they tell us that they invested $300,000 for a 40% interest, okay? We're going to appropriately use the equity method. Okay, and they tell us some stuff that I'm not going to worry about here for goodwill or anything like that. It's not important for us at this time, and I don't want to confuse the issue right now. So during year one, small company had net income of 90 and dividend of 40,000. So if they had net income of 90, very simple, kind of fun. I take the what? I take the 40% times the 90,000 income. I increase the investment by 36,000. I credit the equity and investment income. That gets reported on which financial statement?
Income statement.
Good, that's an income statement item. It might be non-operating item, but it's on the income statement. I'll report that 36,000. And then since they told us there was a 40,000 dividend, we take that 40,000 dividend times the 16 times the 40,000. Gives me 16,000, and I reduce the investment. Okay. Now, if you're being asked a question on the exam and they're just asking you, and you'll see some of these in our class questions here and definitely in your homework and on the exam, of course, you're going to see, well, they're not going to ask me, make a set of journal entries probably. They just may ask me what should be the ending balance in the investment account, and you can use our base mnemonic. Okay, and you would have what? Beginning balance in our little example was what they paid for the investment. I forgot, what was that number? 300,000. This over here, I guess 300,000 was the beginning balance. We added the net income, which was what? Our share of the net income was 36,000. We subtracted what? Our share of the dividend, which was 16,000. And then we had the ending balance would have been the correct answer to a question like this, 320,000. That's the way they're going to ask you, and you can use our account analysis format, the same thing we were using earlier for accounts receivable and whatnot, to calculate the ending balances in questions like that. Okay. Okay, good. Now you come over and they say, well, what happens if you have both common stock and preferred stock? Can happen, right? Okay. First of all, the significant influence test is only applied to common stock because common stock tends to be the one that has voting rights. And so you don't really exert significant influence over preferred stock, right? Okay. The calculation, however, of the income of the subsidiary will be whatever the preferred stock dividends are and the percentage of the common shareholders the income available to the common shareholders, which means you have to take the total dividend minus the amount that went to the preferred shareholders. And then that's the amount that's left that's available to common. Then you would multiply that by whatever the percentage share of the voting common stock you have. That's the amount that goes to the investor. Okay. And then, of course, you'd have to add in whatever the preferred stock dividends were that you would be getting as a holder of the preferred stock. Okay. So flashcard those rules, but let's look at this very nice example on the next page. A question on the next page. Okay. And I'm going to go ahead and ask you to work that question 2 first, because that applies to those rules right there. Okay. That we just looked at. So let me put the poll up. I'll give you a little more time with this one, guys. This one's a little bit involved. Okay, guys, we're coming up on 3 minutes now, so I'm going to go ahead and ask you to make your choice. Okay, and okay, pretty good for a kind of hard question. Okay, I realize this one's a little tougher. 83% of us got this right, so that's good. Okay, now let's just go ahead though, and let's walk through this one. Okay, which is kind of following those rules that we just flashcarded on the previous page. And so you look, and they tell us that we have this 20% of the preferred stock. And then we got what? We got 40% of the common stock. So we're going to use the equity method because we're well past that 20% threshold. By the way, the exam isn't going to have you at like 19.99999% and see if you know whether or not to use the equity method. They're going to put you well into the percentages for the rule of thumb for the equity method. If you're below that, they still may say, well, you exert significant influence, which then of course means you should still use the equity method. Okay. But we take a look here and they tell me that there was net income of 60,000 and they paid dividends of 10,000 to the preferred shareholders. Now, the way I look at that question is I sit there and I say, well, hey, 10,000 times what? Times the 20%. I know that there's at least 2,000 that's coming to us from this preferred shares. I'm just going to put P here for preferred. Now I just got to figure out, well, what percentage of the income should I take? I know it's, well, I don't have to figure out the percentage because they told me I'm what? 40%. So I know I'm going to apply 0.40 to some number. What's it going to be? It's going to be the 60,000 of net income minus what? The 10,000 of preferred dividend. So that means that I'm going to only have 50,000 left for my common shareholders, of which our company here deserves 20% of that. Excuse me, 40% of that. So that's going to give me what? An additional 20,000 for the common investment. That means that I've got 22,000 of dividend income for the preferred plus my share of the net income of the common based on my common shareholdings. Question? Okay, good. Let's take a look at this one. Okay, guys, we're coming up on 2 minutes for this, and so I'm going to go ahead and end the poll. So make your best selection. And okay, it looks like we've got most folks choosing the correct answer here, which is B. I think that what I'm seeing as a trend here is we've got a good solid, core of 80–85% that are comfortable with this material. And then we've got some folks that seem a little bit to be wandering a little bit, but let's just go ahead and let's take a look at it. I don't know that it's the same. Sometimes you might get one right, you might miss one, but let's just take a look. And we have on January 2nd, year 3, and I'm a little concerned of the people that pick C and D, okay, which I had one person pick C and one pick D, because I don't know of a scenario where we start having earnings and investments that come in and the investment account should stay the same. unless, and I don't know of anywhere it should go down. I'm not sure why somebody would pick D. Maybe see if you thought that we shouldn't use the equity method, maybe. Okay, but they tell us here that on January 2nd, the correct answer here is B. Okay, but when we look at this one, they tell us that we purchased 10%, but they're the largest shareholder, and the officers are majority on the board of directors. Well, that's enough. I mean, that's the kind of thing where they're below the 20% threshold, but they're giving us, bright lights flashing, say you exert significant influence, or the investee does here. So that means that the beginning balance is 400,000, right? Just using the base mnemonic. I have to add what? The share of net income under the equity method. Okay, so what do we got? We've got net income of 500,000, of which we're owning, and we use the 10%. Okay, we don't make up an amount, to bring us up to the equity method or anything. We just use that 10%. That's enough. The 10% is enough to exert significant influence from everything the problem told us. And then there was dividend of what? Of 150. So of the total dividend of 150, okay, I subtract the dividend. It says dividend of 150 times the 10%, that's 15,000. That gives me the correct answer here, the 435. Okay. Question? Okay, good. Now let's come over and see what happens if there's a difference between the purchase price and the net book value of the assets. Okay, and when that happens, we will first allocate any of that excess. Okay, any of the excess first will go to write up assets to fair value. And then any remaining amount is goodwill. Now be careful. If we're sitting here in the equity method, that goodwill is not reported anywhere. So the question would say to you, what's the implied goodwill? What is the amount of goodwill? If the question says, what is the amount of goodwill to be reported? The answer is 0. Goodwill is only reported what? On consolidated financial statements. Okay, so there would be no goodwill reported anywhere. You just simply paid more than the fair value of the assets. That difference is goodwill, but that goodwill does not get reported anywhere on the financial statement of the investor or the investee until such time that what? We move past the 50% and we consolidate, then we will start reporting goodwill. So be careful with questions, and it gets frustrating. I promise you, you're going to make the mistake when you're doing your homework. It's going to say, what's the amount of reported goodwill in the transaction? We're acquiring less than 50%. So the answer of reported goodwill is 0. If it says what's the goodwill or what's the implied goodwill or something like that, then you would make the calculation in concert with this step. First applied to the fair value of the assets, and then any remaining amount goes to goodwill. Now, what happens? You will write the assets up to a higher fair value. So they'll give you the net income of the investee, but to calculate the amount of net income that the investor is going to report on the income statement under the equity method, you will have to subtract any excess amortization, any excess depreciation that should be taken on assets that you've written them up. The assets were listed at 10,000 and you wrote them up to 15,000. Now, instead of depreciating, 10,000 over, say, remaining 5 years, you'd have to depreciate 15,000 over remaining 5 years, which is going to bring down the income of the investee and thus bring down the equity investment income report on the income statement of the investor. Okay, so that's what we start to say over here. Okay, the excess of the asset's fair value over its book value is amortized over the life of the asset, unless we're talking about land. Okay, and if that's the case, then that excess depreciation, amortization, whatever you want to call it, is going to be what? Is going to be a reduction in the investee income that we report on the income statement, and thus that will reduce the amount that we report as our balance for our investment in investee. Okay, now guys, that sounds more complicated than it is. So let's just go ahead though, and let's look at this fact pattern here. Okay, and you're going to see that that's not that difficult once you start to look at it. And it's similar to the fact pattern that we had here a couple of minutes ago. So this big corporation acquires 40% interest in small company for $300,000. At the date of acquisition, small company's net assets had a book value of $550 and a fair value of $600,000. The difference between the book value and the fair value relates to equipment being depreciated over remaining life of 10 years. And then they tell us the net income, and they tell us the dividend. Okay, now when you come over and you look, and guys, this part is exactly the same as we saw a minute ago in the example, the 300,000 going to the investment account, right? The amount that's reported on the income statement for our share of the investee's income, the reduction for the dividend. So we saw all that already. Okay, now you come over and let's see what we're going to do with some additional calculations here. And the way I do my the way I look at questions where they're asking me what is the amount of implied goodwill associated with an equity method investment, in other words, I'm below 50%, I always look at it as, well, what did I pay and what did I get? Okay, so they tell us that I paid what? I paid for this 300,000. Right, I paid 300,000, and for 300,000, I got what? I got 40% of something that had a fair value of what? Of 240. So if the question were to pose to me, what is the implied goodwill? The implied goodwill is what? 60,000. I always look at questions like that. What did I pay? What did I get? Now we're going to have to do this a little differently if we're going to consolidate but for goodwill questions where they're asking me goodwill where I'm below the 50% and I'm using the equity method, this is the quick, easy way to get these. Okay, so that's the amount of goodwill. But now I want to say, well, what's the asset adjustment? Okay, so to get to the asset adjustment, I'm going to sit there and say, well, look, the assets had a fair value of 600,000. 40% of that is 240. They had a book value of what? 550. 40% of that is 220. So there's a write-up of the assets of 20,000. And guys, I showed you the goodwill calculation right here, but I just wanted to write what did you pay versus what you got. Okay, there's the goodwill. But now I need to do what? Now I need to amortize, depreciate that additional value that I just applied to the equipment. So I would go ahead and I would debit the equity in the investee income, and I would credit the investment account. So if you were to look at that and they were to ask you, well, what's the amount of income you should show? It's the 36 minus the 2, because I would have been taking additional depreciation on that particular asset, the 20,000 divided by the 10 years. And of course, since I decreased the investment by that decrease in income, then I would have to credit the investment account for that 2,000. So they may ask me the ending balance, which would be the 318, the 320, like we calculated in the previous example, minus the 2,000 excess amortization depreciation. Question. Okay, be careful, guys, when you look at questions in your homework. Again, it's going to get frustrating. They're going to give you an equity method question, and they're going to say, what's the reported goodwill? Answer is what? 0. Okay, that's a 0. 0. If they say to you, what's the implied goodwill? What did you pay versus what you got at fair value? Okay. Now, if there is impairment on an equity method investment, okay, that happens when the fair value of the investment falls below the carrying value and the entity believes that the decline is other than temporary, okay. If both conditions are met, then report an impairment loss on the income statement and the carrying value of the investment would be reduced to that lower fair value. So in the example where we just had 318, if they told us fair value was 315, you would have to write that down and report an impairment loss. Okay, and under US GAAP, which is the only kind of GAAP that's tested on the exam, you cannot reverse the impairment loss in subsequent periods. Flashcard those rules. Okay. Okay, good. So let's go ahead. I don't think we need a numeric example for that. So let's just go over to some multiple choice questions for the equity method. Did I launch the poll, guys? No?
I don't see it.
How about now?
Nope.
Okay, well, let me do this. Close this entirely. I don't know why it's not showing the poll. Share results. No, I'm not seeing it there. Relaunch poll. Still don't see it?
No.
Well, I don't know what's going on. Let's try this. If this doesn't work, I don't know what will. Yeah.
Yes.
Okay. Okay, we're a little under 2 minutes, but it's looking to me like everybody has had a chance to try this one. So I see no reason to wait any longer on this. So let me end the poll and share the results with you. And pretty good. The one problem with this particular lecture, I probably shouldn't say this. There's too many questions that the choice is B. I don't know. I think they were being cute here, being cute, making it B all the time. There's a few that aren't, but anyway. So the answer here is B. Now I'm going to stop sharing and go through this one with you, but when you look at this one, they tell us that there is an excess for the inventory and an excess for the land, and they want to see what will be the effect on the share of earnings that the investor will put from the investee's income. Now, when you look at land, because we don't depreciate land, there is no effect on net income for a write-up in the value of the land as it goes from the consideration from the investor to the investee. So we know that the answer can't be what? Can't be A and can't be C. And I don't think anybody picked those. So that was good. The inventory requires a little more thought. They tell us they use what? The FIFO method for the inventories. So that means that the beginning balance was what? Should have been higher because we would have considered that the higher fair value. Whatever purchases were, I don't know. Okay, but that means that what? Goods available for sale would be what? Higher. Okay. The ending inventory is whatever it is at current market prices because we're using FIFO. And so remember when we talked about ending inventory is pretty much at replacement cost under FIFO. So there really wouldn't be any effect on the ending inventory there. So if my goods available for sale are higher, then my cost of goods sold is going to be what? Higher. If my cost of goods sold is higher, my net income is what? Lower. And so that's why B is the correct answer. Question. Okay, good. Let's look at a couple more. By the way, guys, this type of question, and you see these quite a bit in consolidation type questions, the way the CPA exam used to be when I took it, back 1,000 years ago, okay, there was a theory section of the exam, and most equity method consolidation questions were asked on the theory portion of the CPA exam, and there were no numbers. It was all questions like this, and sometimes folks thought that was the harder part of the exam because you couldn't sort of, bludgeon your way through a question, for lack of a better term, to get the right answer. You had to really sort of understand what you're doing. So questions like this, even though there's no numbers, sometimes can be more difficult than ones that have numbers in them. So be ready for that type of thing. You don't see them as much these days, but you still will see some questions like that. Okay. All right, good. Let's go ahead and let's take a look at another question. Okay, guys, I'm gonna go ahead and end the poll. Looks like everybody's had a chance to try this one. And okay, pretty good results. We're holding at that sort of 83% that are doing pretty good. I think that the couple of folks that picked A, probably, you know, we're trying to remember, what did John say about it always being 0? And the key word for it always being 0, guys, is if it says what should be reported. Okay, so you're going to get more comfortable with that as you look at some questions where the answer is going to be 0 in a situation like this question contemplated, where you're using the equity method because you're under 50%. Okay, so you're not calculating goodwill that would be reported at a consolidation, but they're asking me what is the goodwill attributed, or if they say what is the goodwill implied associated with that. Just be careful. It says the goodwill reported, then the answer is 0, because goodwill is only reported on the consolidated financial statement. Okay, now with that as an understanding, then this question should become pretty easy for you, because you know that this couldn't be it because they didn't say reported. And you're just going to say, well, what did I pay versus what did I get? Okay, and what did I get? Fair value, right? Okay, so they paid what? They paid 200,000. And what did they get? They got fair value of 600,000. And they bought 30%, so they got 30% of that fair value, which was what, 180,000. Therefore, the implied goodwill, the attributed goodwill, the phantom goodwill here, because it doesn't get reported anywhere, is 20,000, but it's not the reported goodwill. Reported goodwill is 0. Okay. Okay, good. Let's take a look at question 5. Okay, guys, we're up in about 2 minutes now, so I'm going to go ahead and end the poll. And again, we're holding pretty solidly at 83% getting this right, which is choice B, okay? And I hope it's not the same two folks that are missing the question every time, okay? But let's take a look at this one. And this one was a little involved. In fact, I probably could have given you a little more time on it. This is a question that might take you 3 minutes on the exam, but really should not take you more than that. But let's look. And we have what we acquired 40% of the common stock on January 2nd, year one for $400,000. The carrying amount of Straw's net assets at the purchase date totaled $900,000. Fair value equal carrying amounts for everything except equipment, which exceeded its carrying amount by $100,000. Now, something that I like to do with these questions, just to make sure that I'm following, I'm saying, okay, they're telling me the book value was 9. They're telling me that there were assets that exceeded the book value by 100,000. The fair value exceeded the book value by 100,000. I like to look at those questions and I say, well, okay, 400,000, right, is what they paid here. And I divide that by what? 0.4. That gives me what? 1 million. Okay. In other words, the fair value of the investment, okay, the fair value of the investment times 0.4 is what they should pay, and they paid 400,000. So that's how I got to that calculation. And then the fair value, I'm saying, okay, well, that's $1 million. Okay, got that. Now, once I determine that, then they tell me that the carrying amount, the book value was 900,000. So the 900,000 means there's $100,000 difference, and they're telling me that that 100,000 difference is this equipment. I like to go through that exercise a little bit because I think it helps us later on when we start getting into consolidations. And so it might not be a bad idea for you to do that, although it was not necessary to answer this question, okay? They want to know what amount of income should we report from the investment. And what I would do to answer this is I would go ahead, because some questions may then follow on and say, well, what's the ending balance in the investment? And what's the amount of income from the investment? So I would go ahead and tee both of those up since they're related to each other in terms of the journal entry. So I know that when I purchased the investment, I debited the investment, I credited cash, whatever, for 400,000. Then what? Then I know from what we've talked about already that I should take my share of the investee's income, 150,000 times 0.4, the investor's share. When I say mine, I'm talking from the standpoint of the investor. That's going to be what? 60,000. I'll credit the income, which is what I need to do to answer this question, but I'm just going to debit the investment too at the same time. Then they tell me that there was no dividend, so I don't have to worry about dividend here. But then they had already told me that I have 100,000 of excess value, right? And I'm going to what? Have to depreciate that over 5 years. Where do they tell me the 5 years? Right here. Okay, so I depreciate that over the 5 years. That's what? 20,000 per year, but I'm only accountable for what? I'm only on the hook for 40% of that, whatever. So I would go ahead and 20,000 times 40% is 8,000. I would credit the investment. I would debit the income for the 8,000, thus giving me the correct answer here, which is what? The $52,000 for the income for the year. Question. Okay, good. Now, if you have, we don't need to worry about that comparison. If you have a situation where we had originally acquired less than the magic 20%, we didn't have enough to exercise a significant influence, and then later we purchased more, then all you do is you go forward from using the fair value through net income method to now doing what? Add the additional cost, obviously, to the investment account. And going forward from that point forward, we would use the equity method. you should, kind of fall to one knee for that change in rules. There was a time where they made me go back and calculate, FASB made me go back and calculate a cumulative effective change in accounting principle, and it was a mess the way they had you do that before. I guess FASB took pity on companies, probably the uproar from companies was like, what are you doing to us? And so they changed the rule here and said, okay, just go forward with the new method. We're telling you that's okay. You don't have to treat that as a change in accounting principle. Okay. Okay, good. We don't need a numeric example for that. All right, so we're always at this little crossroads here in this discussion, in which we're going to go in and start talking about the consolidation, and there's obviously not enough time for us to reasonably finish. Let's see, what can I do here? I'll tell you what I'm going to ask you to do, guys. Okay, I'm going to end class. I'm going to ask you though to look at module 3 on your own. Okay, I'm going to give you a little time here to look at it on your own. It gets into a rather lengthy discussion of variable interest entities, and I just find that this tends to be a deadly amount of me just reading to you. So rather than put you through that, what I'd like you to do is take a look at module 3, okay? And then what we'll do on next Tuesday is we'll wrap up chapter 4 here, in that I will get you started on chapter 4 and we'll go forward in chapter 4. We'll finish chapter 4 and we'll start with module 4. We'll finish the chapter 4 next time. Okay, so go ahead and look at that. You see there's not a whole lot there, and we will start with module 4. I think is best next time, because I can't reasonably finish module 4, and I don't like to start something and cram it in at the end here. And then we're kind of like, what did we just say there? So let's just go ahead and end now. We'll end a little early. Do look at module 3 on your own. You can look at the video. You can look through the multiple choice questions there, and we'll hit the ground running on module 4 next week. Okay. Question? Okay, guys, if there's nothing else, then I will see you next week. Keep cooking away at these homeworks, okay?
Thank you.
Thank you. Have a good night.
Bye-bye. Have a good night.